Assalamualaikum and salam sejahtera. This video is prepared for the discussion on the financial statement, alright, on the preparation of financial statements without adjustment. Alright, so I'm choosing question number 7 from page 99 of your textbook. Alright, so before you prepare the financial statements, alright, as per requirement here, of course you'll need to know the format for the financial statements. Alright, so there are two statements here. The first one is the statement of profit or loss, and the other one is the statement of financial position. Alright, in statement of profit or loss, usually we report item of revenue and expense, whereas for statement of financial position, we report items of asset, equity, and liability. Alright, so in the statement of profit or loss, okay, we're going to start with sales, right, and then we are going to minus, okay, if we have any sales return or sales discount, alright, or we call that as discount allowed. Alright, and then sales, okay, will be minus with cost of sales. Okay, so how to calculate cost of sale? Alright, so cost of sale is opening inventory. It consists of opening inventory, purchases, and then minus if we have any purchase return or discount received or purchase discount. Alright, do we have any other cost related to purchase? If it is yes, then you are going to add them here. Okay, for example, carriage inwards, duty on purchase, insurance on purchase. If you don't have this cost, then you don't have to show it in the statement of profit or loss. Okay, alright, so opening inventory plus purchase plus all costs related to purchase, okay, is equal to cost of goods available for sale. Alright, cost of goods available for sale. Okay, we have inventory, opening inventory, we have purchases, right? So these are cost of goods available for sale. Alright, and then we're going to less closing inventory. Even though these goods, okay, from the previous inventory, from the purchases that we have made during the year, alright, not all goods, okay, not all goods are able to be sold within the same year. Alright, so if we have any closing inventory, then we are going to minus. So this will represent cost of sale. Okay, so this will present cost of sale. Alright, and then cost of sale will be deducted from net sales. Okay, alright, so it would be equal to gross profit or loss if it is negative. Alright, and then we're going to add other income if we have any. Alright, for example, rent received, commission received, interest received. Alright, and then we're going to less with the operating expenses. Okay, it can be anything. It can be salaries and wages, insurance, or other items. Alright, depending on the business. Alright, and then gross profit plus other income minus operating expenses, okay, is equal to net profit or loss. If it is positive, then it is profit. If it is negative, then it is loss. Okay, what about the statement of financial position? Okay, so statement of financial position, we have non-current asset, current asset. So this is total asset. Okay, that's it. And then financed by owner's equity, non-current liability, and current liability. So this is the total for owner's equity. This is the total for equity and liability, this one here. All right, whereas the total here is for total asset. All right, okay, all right, so now from the list of balances extracted from the books of Anda Trading, okay, as at 30th November 2002, okay, so before we proceed with the preparation of the financial statements, okay, we should classify this item first into their category, so then it would help us to prepare the statement easier. All right, okay, all right, so let's start from petty cash. Okay, so when I classify this item, I'm going to be quite specific. Instead of asset, I'm going to classify them into either current asset or non-current asset. Okay, so petty cash is current asset. Okay, and then we have cash at bank. Cash at bank is current asset. Account receivable is current asset. Okay, opening inventory. Okay, inventory as at 1st December 2001 is an opening inventory. But how do I know this is an opening inventory? Because in the requirement below, okay, you are required to prepare for year ended 30th November 2000x2. Okay, meaning that the accounting period will end on 30th November 2000x2. Okay, so when the accounting period began, all right, 12 months before that, which is on 1st December 2000x1. Okay, so this is the accounting period for under trading. Okay, so because of that, inventory on hand as at 30th November 2000x2, this is closing inventory. Okay, so where do we show this closing inventory? In current asset. Alright, other than that, we are going to show this closing inventory in cost of sales. Alright, okay. So let's go back to the opening inventory. So the opening inventory here, okay, well, this is not our current asset, okay, but this is cost of sale. Okay, and then we have motor vehicles. So this is non-current asset. This is non-current asset. Investment also non-current asset. I hope you still remember that there are three categories of non-current asset, which are tangible item, intangible item, and investment. So investment is part of non-current asset. Freehold premises, of course, this is non-current asset. All right, and then we have account payable. So this is current liability. Okay, 10% mortgage on freehold premises. Mortgage usually took more than 1 year. Okay, for the repayments, okay, of mortgage, it took more than 1 year. So this is non-current liability. Okay, and then we have capital at the beginning of the year. So this is owner's equity. Okay, so purchases is cost of sale. Wages and salary is an expense or operating expense. Okay, so rates and tax also operating expense. Okay, interest on mortgage. Okay, mortgage itself is non-current liability, but any cost on mortgage, any cost of borrowing, for example, the interest. Okay, so interest is an expense. General expense, definitely an expense. Carriage outwards is an expense. Insurance premium is an expense. Okay, drawing is part of owner's equity, except that it will reduce the owner's equity. Carriage inwards. Okay, carriage inwards is where you incur the cost for the transportation of goods from the supplier to your premise. Okay, so this one is related to purchase of goods. So this is cost of sale. Advertising expense is an expense. All right, so sales, of course, sales. All right, and then we have sales return. So we're going to group them together as sales. So like I said, I'm going to be very specific. So sales is sales. All right, this one is related to sales. However, it's going to decrease the sale. Okay, and then we have purchase return. So this is part of, okay, purchase return is part of cost of sales. Okay, discount received is cost of sale. Okay, discount allowed is related to sales. Allowance for doubtful debt, this is part of current asset, but it will reduce the current asset. It will reduce. Allowance for doubtful debt is provided because there is a tendency that one or two of account receivables may not make full payment of their balance. All right, so we provide doubtful debt. We provide a provision called doubtful debt. All right, so this will reduce the account receivable in the current asset. Sales return will reduce sales. Purchase return will reduce purchases. Discount received will reduce purchases. Discount allowed will reduce sales. Okay, all right, so let's start with the statement of profit or loss. Okay, so now you have identified. You have identified the item. All right, so you are going to show them in their correct statements. Okay, for items such as current asset, non-current asset, owner's equity, current liability, and non-current liability, okay, they are going to be disclosed in statement of financial position. Okay, items that I have shown here as, all right, or I have noted here as sales, cost of sales, okay, other income if any, but we don't have it here. All right, and then expenses E. Okay, this item we are going to disclose in statement of profit or loss. All right. Okay, so let's move to the preparation of the statement of profit or loss. Okay, so usually we are going to begin with the statement of profit or loss, because why? Because at the bottom of the statement of profit or loss, we calculate net profit or loss. So net profit or loss will affect the owner's equity. So the first step is to prepare the statement of profit or loss, and the second one is to prepare the statement of financial position, because we are going to transfer the amount of net profit or loss to the statement of financial position under owner's equity. All right. Okay, so I have prepared one here. Okay, so I transfer from the question here, okay, from the item that we have identified here. For example, here we have sales. Okay, all right, sales. Okay, so sales. Okay, so this is the statement. So in the statement of profit or loss, we are going to start with sales. All right, so we simply transfer the amount. Sales 250,000, so transfer to here. All right, and then do you have any sales written? You go back and then you see, all right, yes, I do have sales written, and then I do have discount allowed. All right, so sales written, discount allowed, then you deduct from sales. Okay, all right, and then the total you transfer to the next column. Okay, similarly for cost of goods sold or cost of sales, all right, less cost of sale. Okay, this will be the same thing. Okay, cost of sales or cost of goods sold, they are the same thing. All right. Okay, so the how to calculate cost of sale? Okay, it is equal to opening inventory plus purchases minus any purchase return minus any purchase discount. Okay, plus any cost related to purchases. Okay, in this case we have carriage inwards. All right, so altogether it is equal to cost of goods available for sale. All right, and then minus closing inventory. Okay, that's it. Okay, and then you have here your cost of sales. Right, so this is your net sales. Okay, and hence, okay, your gross profit is 123,300. Do we have any other income? No, we don't have other income. All right, and then but we do have operating expenses, which are wages and salaries, rates and taxes, interest on mortgage, general expenses, carriage outward, insurance premium, advertising expense. Okay, so this item, okay, are the items that we have identified earlier, okay, from the question here. Okay, wages and salary up to advertising expenses. All right. Okay, so the total is 113,000 ringgit. Okay, now we're going to calculate net profit or loss. Okay, so how to calculate this one? Gross profit plus other income, if any, minus total operating expenses. So it is equal to net profit or loss, which is 10,300. All right, so once you settle preparing the statement of profit or loss, then you're going to move to the next one, which is the statement of financial position. All right, for the statement of financial position, for the item of non-current asset, we should have these three columns. Okay, cost, accumulated depreciation, and the carrying amount. Okay, later on you are going to learn on the computation of the depreciation for the non-current asset, especially the tangible item. All right, we are going to provide depreciation, okay, because we use the asset. Okay, so we want to recognize the usage of asset. Okay, so we provide depreciation. Okay, so for now we don't have that. All right, so we are going to fill in only at the cost. All right, so motor vehicle, okay, plant and machinery, freehold premises, the cost is okay 14,000, 50,000, and 147,500 ringgit. Okay, and this would equal to the carrying amount. Okay, if we have accumulated depreciation, then the carrying amount would be different, because the formula for carrying amount is, okay, carrying amount is equal to cost Okay, equal to cost minus accumulated. Okay, accumulated depreciation. Alright, I'm sorry that it didn't write properly. Okay, accumulated depreciation. So carrying amount is basically cost minus the accumulated depreciation. Alright, okay, so then we have one item, right? From the list of balances that we have here, we have long-term investment. Alright, so for long-term investment, okay, usually we show that after we present all the tangible items, okay, in non-current asset. Okay, because long-term investment, we don't have accumulated depreciation. Alright, so long-term investment will be shown in the last column here. Okay, in the third column. Alright, and then we have current asset. So we have identified here there are a few items of current asset: petty cash, cash at bank, account receivable. Okay, and then we have closing inventory. Alright, and then we have one item related to account receivable, which is allowance for doubtful debt. Alright, so how we prepare how we show the current asset. Okay, so usually the preparation of the current asset, we started from the closing inventory. We started from the least liquid, meaning that from the current asset item, which are the most difficult to convert into cash. Okay, which are the most longest to convert to cash. Okay, all right. So closing inventory. Okay, and then followed by account receivable. Okay, so for account receivable, we provide a provision or allowance for doubtful debt, meaning that there is a possibility that this balance, okay, cannot be collected from our debtors. All right, so we provide an allowance, we provide a provision. Okay, and this is cash at bank, this is petty cash from the list of balances. Okay, all right. So the total is, okay, 51,740 for current asset. Okay, so add all together. Okay, the total non-current asset here, okay, plus the current asset here. So the total asset is equal to 273,240. All right, and then all of this, okay, all of this are financed by honest equity, non-current liabilities, and current liabilities. So honest equity, we have capital at the beginning of the year, net profit or loss from the statement of profit or loss and the drawings. Okay, all right. So capital is, okay, 219,840. Net profit, the one that we so this amount is transferred from statement of profit or loss, okay, and then minus the drawing. Okay, and then non-current liability, we have only one item, 10% mortgage, and then current liability, we have only one item, account payable. So the total equity and liabilities is 273,240. Okay, all right, so the balance, okay, or the total should be equal, because this is from the accounting equation where asset must equal to equity plus liability. So if you get a correct balance of total asset, if you get an equal balance of total asset and total equity plus liability, all right, it means that, okay, your preparation of a statement of financial position is correct, inshallah. Okay, all right, so that's all, okay, for the discussion of the preparation of the financial statements. Okay, for question number 7 on page 20, on page 99. All right, okay, thank you.